Welcome, everyone, and thank you so much for joining us at the TCFA annual conference. This is our 25th year anniversary, and we really appreciate your appearance. It is my great pleasure to introduce the outstanding guest in our Global Investment Opportunities and Strategies panel. Ray Dalio once said, "The only free lunch in investment is diversification." I think our panel here is probably the most diversified we can ever find. So first, Chris Rapsowich. He's the Director of Risk and Operations at Helmsley Charitable Trust, which is a nonprofit organization, and he's an expert in nonprofit endowment management. James Sweeney, who is the Chief Economist and CIO America of Credit Suisse, a renowned economist in an esteemed bank. And the last one is Irene Xie. She's a founder and the CIO of Share Capital Management, which is a macro hedge fund. And she is also an accomplished concert pianist. So I don't think we can find any panelist more diversified than this. And I think that's kind of free lunch for everyone, both in the audience and also online. And thanks for them coming. All right. So many of the audience today here are either student or they are young professionals. Interview is an important part of their career development. So I want to ask the audience one question. How many of you just had interviews in the past 3 months or is expected to have an interview in the next 3 months, especially after you get a bonus for this year? Some of them raise their hand, some of them don't. I guess maybe they don't want to let other people know. So in terms of interviews, one of the best questions I read is by Peter Thiel. He wrote in his book, From Zero to One, that his favorite interview question is, what important truth do very people agree with you on? So in this Global Investment Opportunity panel, I'd like to ask this tough question to our panelists. I wanted you to give us audience some example that you think are true, but very people know or agree with you. So I will start with Chris.
Actually, can you hear? Yeah. Actually, I have a very long list of them here. But more seriously, and I'm going to, you will see, if you look at the second bullet point there, you'll see that what we're doing is to maximize grant making. Part of the challenge I face in my work every day is that people think I should be maximizing returns. And this is a truth that everybody holds in the investment world, that you should be maximizing returns, maximizing portfolios. Actually, at a nonprofit where our goal is to give away as much money as possible, it turns out that maximizing returns is actually not enough. You actually have to focus on something more important, which is what you actually do, and that's giving away grants. Should I interrupt, give a bit of background in the context? So, of course. Just to give you a bit about the Helmsley and what it means is, Helmsley is a 501c3 foundation with $6 billion, and our goal is to help chiefly medical research, and by law, we have to give away 5% of our assets every year. So that's $300 million every year that we give to various causes, including type 1 diabetes, vulnerable children in sub-Saharan Africa, Crohn's disease, etc. Now, I'm on the investment team that has to make that back. Now, if we were to maximize returns, we would be focusing only on the dollar amount that we have and trying to maximize that at every time. The problem with maximizing returns versus maximizing grant making, or actually managing grant making, is that grant making, which is 5% of your asset base on a look back, so it's an Asian option in practice, has a path dependence. And so the path dependence by which we make the returns is extremely important. When people focus on returns, they think of geometric returns, and interestingly enough, you can permute geometric returns and you still get to the same result. So if you take 10 years of returns, you permute them in any order you want, you get to the same result. However, if you do that, taking off 5% every year, you can change on a, sort of just taking something, let's say, that makes 7% average or 5% reals over 10 years, you can change your grant making by up to $1 billion between the various outcomes. And so by focusing on maximizing grant making is something very different. But when we go into investment committees, we're always being challenged to maximize returns. And you have to explain again and again and again that actually, if you really think hard about what the goal of a foundation, what a trust is, it's to actually maximize grant making, and that requires a different investment strategy.
Thanks, Chris. So James, can you give us some thoughts?
Thank you. I think I'll also stick to talking about something work-related to answer this philosophical question. But I think the physical world obeys mathematical laws. I think the economy obeys mathematical laws sometimes. And the interesting part is when it doesn't. And to have a sense of how and why and what's next when we're in one of those doesn't times requires thinking about structure, thinking about details. We do a lot of work on how balance sheets in the financial system link together, not just who's leveraged, but who's lent to someone and made them leverage, against what collateral, what's the role of the central bank, what's the role of the regulations and the rules. We've had a little incident recently with the Fed we were just discussing, with repo rates and the Fed's balance sheet now growing again. We don't find that alarming longer term. We think the Fed is doing what they've been doing for 100 years and supplying the level of reserve balances to meet the demand for reserve balances. But I think staying focused on the details and the rules of the game and how the financial system is changing is critical for thinking about what risks the economy faces, and paths to recession and paths to financial crises, and these are the things that we focus on in a lot of our work. So I won't be very specific right now, but I think just as a deeper truth underlying an approach, that's something that we hold close.
Thank you, James. We'll come back to these questions later on. And Irene, can you please tell us, what do you think?
The thesis that we usually run about 2 to 4 theses in our book that try to capture the big macro trend. There's one that we have consistently got a lot of pushback on. Whenever we go and present a more bullish view, optimistic view about China in the policy circle, in investment, among our international domestic investor, this is where we get a big pushback. And the thesis we always brought up is, look, China is leaping up the value chain very rapidly, and now the R&D and the research and development spending now is on par in America. When we cite the statistic, for example, they just announced a program to invest just specifically using artificial intelligence into genomic, about a $10 billion program that spanned over 15 years. And then we say, well, let's compare the statistic. What is America spending during the Obama administration? That number was $215 million. Okay? When we brought up the leap of value chain where they are on technology and research and spending, that's where we get the most pushback, which I find is it's going to be a very, very unique emerging market or developed market opportunity probably in the next 10, 15 years, which I will elaborate on.
Right. Thank you. So we talk about opportunities primarily. And what do you see the risk in the next maybe 3 to 6 months, or in Chris' case, more longer-term risk that you see in the current market? Yeah.
Well, for us, we have, about a couple months ago, we have begun to see a very big macro landscape shift in next, I would say 3 to 9 months. It's really primarily come from the 2020 election in the United States. And to be very honest, because we've been in years of QE now for the last 10 years since the financial crisis, from our investment perspective, we have actually spent very little time in the United States. We find it very boring, low volatility, low interest rate, and there was just not a lot of analysis to do, like what James said, outside the central bank. And about a couple months ago, we began to see that this may be changing, and now we are deploying a fair amount of resources internally on polling, or analyzing policy of the 2020 election. That, to me, could be a real big shift in terms of the macro landscape. If we get a Democratic candidate outside of Biden, either Elizabeth Warren or Bernie Sanders, I think that is a game changer. I think if you think about the Trump presidency, you say, okay, that is a 3x event, that's how impact macro market. If we get Warren or Sanders, I think that is a 12x event on the shift. And I think that could have very substantial impact on asset market. And we think that could be somewhere between 30–40% down in equity market and not recover. So we have been, primarily we think that is the biggest risk on the horizon.
Yeah, I would actually agree that policy risks, policy surprises are very central. And I would actually add to what you said. Yeah, I think if you go back 4 years and you think of how the market was taking some of candidate Trump's proposals 4 years ago, it wasn't very seriously. And he's tried to actually get a lot of those things through. Some of them he has. So if he were to announce something very interesting and surprising in the months ahead, I think the market is going to react differently. So you don't even really have to go to a Democratic candidate to think of policy-driven shocks. You can actually stick with the incumbent on that as a potential disruption, positive or negative. And then I think in terms of what we're already seeing, the trade dispute has had a substantial impact on investment, trade, manufacturing, and PMI data worldwide. It hasn't had a substantial impact on GDP, labor market data in the developed markets. That's very important. If the trade dispute were to worsen in the year ahead, I think the odds of it starting to spill into labor markets and GDP would be more likely. If it were to improve, then we should see a rebound in things like PMIs. Our base case now is that it will get no worse, and it is likely maybe to get a little bit better in terms of the level of tensions and the level of tariffs, and that on a 3 to 6 month horizon should help give some lift to risky assets and yields. It's something we've seen a little bit right now. So I'm on the investment committee for Credit Suisse, and our house view is actually overweight equities right now, partly on the view of a modest de-escalation on the trade war and a small rebound in global growth, only small in manufacturing and trade.
Sort of, at Helmsley, we think on a combination of levels because we are ultimately long-term investors. Obviously, the asset markets going down is a big impact on us because it impacts the level of our NAV and therefore how much grants we can make. But we're also then thinking about what does that mean for our grantees. So we've always got this both sides sort of charitable foundations of a strange place because you're both commercial and nonprofit, and you're thinking about both sides at once. But yes, a big sell-off in the asset markets is always a difficult thing. In fact, we're carrying a fair amount of cash for that reason because part of this idea that we need to sort of make money when it's easy and actually underperform when the markets are much more volatile or much less clear. But obviously, a massive sell-off due to, say, an Elizabeth Warren winning the election would be a tough thing for us. But thinking further ahead, if the economy slows, if we don't actually improve trade and we do go into a global recession, what worries me in the end is where's the leverage and what's it doing? Because the central banks have been pushing us. They've been pushing us everywhere. If you look at our portfolio, it's probably more riskier than it should be. I have to imagine there are a lot of portfolios that are a lot more risky because you're being pushed out the risk spectrum. And who is really taking risks? And in a recession, as we saw in 2008, things like that can come back and bite terribly. Where those risks lie, I ask lots of people, but it's a worrisome question in the back of my mind that's in the near future, I think.
Thank you. So China, obviously, from this panelist, represented both opportunity and risk. So the next question will be more focused on China. So for Chris and Irene, if you can disclose, are you currently investing in China, and what's your thought process, investment thesis? And James, I know you have some very interesting pieces about the China-U.S. trade war. So can you also share with us your views and thoughts? So maybe we start with Chris this time.
So just to give you a bit more, put things in context for the Helmsley Trust, we were actually, our first investment, so Leona Helmsley, who was the founder of the trust, died in the fall of 2007. There were some legal issues, and the foundation was created in the summer of 2008, and our first investment was actually August 28th, 2008. Fortunately, they were relatively conservative investing originally. So if you think August 2008 was our first investment in China, which was in the private markets, was in March of 2011. So relatively soon after the founding of and the initiation of the investment program at Helmsley, we began to invest in China. Chiefly, we focused on the private markets because looking at at the time in particular, if you looked at and this was true more of emerging markets in general, is that your exposure to emerging markets traded equities tended to be either banks or sort of commodity-related investments. And if you really wanted to access the growth of the economy, you really needed to do it through the private markets. And so we actually have about 3% in China. Although we have a hedge fund that's doing long-short in China and private investments. So we have actually about 500 through our private investments, about 500 companies in China, and about 2% of the portfolio is invested in China. And again, the idea has been, how can we access opportunities that are really where the action is, which is really in the private markets.
Okay, thank you. If you have those slides. I mean, I'm going to show you a few quick slides on the trade war issue. I think there are some numbers which are oddly not that popular if you go to the next slide. But the first one is, what is the level of tariffs? And I've had this strange experience in recent months sitting down with people running hedge funds and things like that, and you ask them, what do you think the average tariff is on Chinese exports to the US? And no one knows, which is strange. You would think that would be the first thing that the newspaper would print every time there's an announcement. And this is important because if you look, we're showing there have been a number of serious escalations in the overall tariffs. The path began at the beginning of 2018 when the average tariff for Chinese imports here was 3%, and then it was raised to 6%, then it was raised to 9%. That increase to 9% created a major market disruption towards the end of 2018. Part of that was tariffs were going to go up again to 25% in January. They didn't. But then in May, on 4 days' notice, they did. That created a major market disruption. We immediately changed our forecast a big manufacturing slump in the summer, forecasted a Fed cut in the summer. We got that. And then in August, you got more tariffs. And now, and this again, these numbers are the average expected tariff once everything that's announced goes through. It was 9%, then it was 15% after the May announcement, and after the 2 August announcements, tariffs were set to rise to 26% at the end of December. You went from 15 to an expectation of 26 in a month. And keep in mind, this is an over $500 billion trade flow. It's the biggest bilateral trade flow in the world. So it suddenly was facing a 26% tax, up from a 3% tax in less than 2 years. And that gave us some pretty nasty financial markets and real recession fears and more Fed cuts in the autumn. But now there's a deal, there's talk. But again, the newspapers seem to talk about the talk rather than talk about the numbers. And by my reading of the current situation, the tariffs are probably going to end the year now somewhere between 19 and 23%. Maybe it could be lower. I think if it's lower, it'd be a big positive market surprise. But and maybe not. But I think it is important to focus on these numbers. And if you look at the next few slides, this is the share of U.S. imports coming from China. So neither country's GDP growth or inflation or in the U.S. case labor market data obviously make the point that the trade war has been a big deal. But China's share of U.S. imports has gone from 21% to 18%. Like, that's a pretty big deal. And then if you go to the next slide and you look at what's happened within the year, this is a very busy slide, but this is an example of the kind of detailed work we do. This is global industrial production growth by subsector. So this is the parts of manufacturing that are contributing to global growth in the production of goods, basically. And we don't have every country in here because you don't have data on that. But there's enough countries that we think this chart is representative. And you can see the overall growth rate is very sluggish right now. So global growth is slumping right now in the goods sector, in production, due to the trade war. It's actually been particularly weak a few months after each of these tariff escalations. The contribution of the weakness has been driven by autos and electronics and machinery, which are precisely the categories that you would expect to be most affected by the trade war. So, you know, the bottom line is that, yes, GDP, inflation, unemployment, not necessarily that affected. I mean, we were writing from the beginning that those numbers are unlikely to be significantly affected. But these other numbers, I mean, this thing is correlated with purchasing managers' indices, which are in the 40s in most of the world right now, which is the kind of thing that will get the market worrying about recession and the kind of thing that consistently gets central banks cutting, and that's why we're there. So this isn't the future of the world. This is just how the markets are moving right now. But the point is that this trade war has had a very big impact. And I've also learned in the last year that we're not good at all in predicting the tariff announcements. So we're not sure what's going to happen next. But what we know is it will be highly relevant for financial markets and economic growth.
Thank you, James. Irene?
I think this is going to be a pretty interesting discussion since I'm going to come from a slightly different point of view. So we look at the worldwide market, and one of them are trading, particular from an investment perspective, is very cheap and attractive is primarily the Chinese banks. Okay, so we just went through the trade and how it impacts, and we have a very, very unconventional and consensus view on China. So the market primarily focus on one thing, which is the China debt to GDP. They're too high. This is why we have to tag, you know, extremely low valuations of the banks. And we look at it slightly differently. Our view is that most of the market analysis on China right now, we find them are too focused on the past, but not enough imaginations of what the future can look like. So let me run you some number that you can see them on FT, and that's where the market is focusing on. So the total commercial banking sector, total banking asset to GDP in China now is about 225 trillion yuan. It's about 225% of GDP. So that's where the market is fixated on, okay? So we did a cut from top down and say, let's assume it's going to be a 25% NPL ratio, that 25% of these loans will go bad, and assume that this is going to be a 40% recovery rate of the loans that go bad. And the total hole in the banking system, in our view, is going to be about 40 trillion renminbi. That's how much the losses would be. Now, the pre-provisioning profit in the Chinese banking system is about 3.7 trillion. So in our calculations, organically, they can grow themselves out of the problem in about 3 years. So if you look back in the 2000 workout in the Chinese bank, what they did was they put all the loans into AMC and through what the book value is. And they got very lucky because they have like 12% growth, they grow themselves out of the problem. The market fixation right now is that, okay, this time we don't have 12% growth, like what James just said. We have the trade war and all these factors going on. We got 6% growth, how are we going to grow out of it? Now we see this really differently. We see a long range of plan in history that since 2010 and 12, that how China decided to tackle a problem. So let me just rewind for a moment. Before the supply side reform that they embarked on in 2015, they actually spent 3 years in late 2012 on the anti-corruption campaign aggressively until they started the supply side reform. So they started that in 2015. And then between 15 to 16, they artificially keep the reserve ratio extremely high, it's about 18 to 20%, really to identify where the problem of the shadow banking system were. When they identified that at the beginning 2016, they aggressively clamped down the shadow banking system. And that's why we're seeing the growth that we are, as some of the James slides show. In our view, that the slower growth in last couple years was domestic induced because they tried to liquidate NPL. So that's what we saw top down. And then what we end up doing is we try to go bottom up and get all the accounting data, see what they have done in terms of deleveraging in the shadow banking system. And here's what we found. We found that in 2016, 17, and 18, they liquidated about 1.6 trillion in the renminbi NPL, in renminbi term. And this year, we estimate they will do another 4 trillion. So if you add the number up, we think that between 16 to now, they would have done about 8 trillion of liquidation NPL, i.e. they are now all internal domestic induced to get the bad loan out in return to clean up the banking system. So our view is that instead of what the market view is, they haven't even started deleveraging yet. Our view is that the banking system is about 50% through in terms of deleveraging the NPL. And you can see them from the prices of the loans. They've gone from about 60 cents of dollar to currently about 30 cents of a dollar. And then you can see also the transfer this time, unlike the 1990 NPL cycle, they're transferring the loan instead of at book value, they're now transferring into AMC at market value. So that's our view. Now, much more interestingly, talk about central bank policy, I find the PBOC and the government has been extremely creative. They have done 3 things. I have always said 4 years ago, this is going to be my marker. One, they have recapped the bank through bank pref at the December at a cost of about 4.5% instead of VA equity, which is a much lower cost. 2, they have done a form of credit easing that we did in the United States in 2008, but instead of quantitative easing, they did credit easing by wrapping the bottom part of the credit structure of the new loan for the Big Four. 3, they have introduced this central bank bill swap, which encourage other banks to swap the perpetual bond that they buy for liquidity purposes in order to liquefy the system. So we have we think that if we were right, if we were remotely right, which analyzing China is always very complicated because every time that you think you cover all ground, always something show up that you have to look at them again. But if we were remotely right, they are 50% through the deleveraging system. We see this as one of the best opportunities in the next 5 to 10 years.
Thank you, Irene. I find this very interesting and very different from certain main street views. Thank you so much. So next topic is about technology. Obviously, technology is playing a bigger role in our society right now. And I want to ask our panelists, what's your view? How do you see technology play in the future of the market and also perhaps also in your strategy?
Could you put up the second page of my slide? So just while they're looking for it, so let's just step back over the last...
The second one.
The second one. The last 20 years. So when I actually entered finance as a physicist in 1999, I worked for actually what was in practice a fintech startup. And the cost of the startup was in the millions of dollars. Why? We had to buy Sun software, we had to buy our Sun hardware, we had to pay for a lot of money for software, and then on top of that, there was you had to pay for staff. So we burned in 4 years, $30 million, and I'm not sure how much we really amounted to, but that's a different question. If you look at what has happened over the last 20 years in the technology space, you've got cloud computing, open source software, and sort of various other technology that has simply lowered the cost of creating a software startup in particular. In fact, at one point, I'd been playing with my own sort of quant hedge fund. I could create a better system at home than we built for a different 10 years ago before, and it was all with free software. I could just do it from scratch. So now if you look in 2016 was recent, so instead of a startup costing $2 million minimum for an early round, or 5 to 10 for an early round, we're now at 250 to 500K. So naturally, you've lowered the cost, so supply of technology companies has just exploded as it should. The question then becomes, but that's only in the software space. What is interesting is if you can lower sort of costs marginally on hardware, you could in principle get things there. So either small devices for measuring in biology or medicine. IoT promises to bring that in a different way, to link software to certain versions, to aspects of hardware. And I think that actually is only going to grow in the near future. And sort of when you look at that from one other perspective, which is how we think about it, is that if you look at sort of compare Amazon with Walmart, just as a slightly older example. Amazon is a technology company that has solutions which are in cloud computing, retail, et cetera. That's because they bring a technology, a software approach. I've got this power. What can I solve problems? Walmart, when it bought Jet a few years ago, what did they do? The first thing they did was they changed the culture, trying to fit it into an old line sort of mentality, which was, and where software was simply something to lower costs as opposed to a creative entity, a creative force inside of business. I think that the newer companies that we see are all these, technology is a creative force that changes the world as opposed to something to lower costs. I think that's a really big change that we see now and we're going to see continued into the future.
Yeah, I would largely agree with what we just heard and essentially continue that discussion. I think the capabilities now exist to improve just about every business, using data science, using better software, using the cloud. Obviously, new risks arise with this in terms of security, in terms of regulation, but where 10 years ago, it was hard to construct a very productivity positive narrative about the future. It's much less hard now because of these technologies, although things are a little scary. And I wouldn't leave out, since we're talking technology, what's happening in biology as well. You mentioned something on genomics. There's another area where there's amazing positive developments that are likely and incredible scary developments that are likely to be associated with that also. So technology and recent innovations, CRISPR is basically a decade old. Innovations of the past 10 years have transformed the possibility set for the world economy and for financial markets over the next couple decades.
So let me comment specifically what we do in terms of using artificial intelligence, machine learning, and technology in our investment. I would say the great thing about technology is, and it really is a privilege, I think, to live in the era that we live in now, is it constantly makes you think and rethink what we really have has an edge, has a human. And in this case, really it forces us to really think who we really are as an investor. So I would say that technology intertwined with our investment process in three ways. First is really trade and execution, which we've done since the firm inception 7 years ago, that almost all the trading and execution that we've done are through the machine and have no human touch in it. What it does is eliminated a lot of human error. If you look at our history of how many trade error that we have very few, primarily because we don't really hand touch them. The machine does it, and the machine, like straight through processing, we don't even input the ticket. It went straight to our risk and our system. It will send an alert to our front office, mid office, and then back office and confirm, all within seconds. And we see in our system, in our P&L, and within seconds. So we did that, since before the inception, since the very beginning of the fund. The middle part of the problem to solve is, I would call the information provision, because macro strategy in particular are really about how you gather information, you got to be more precise, and you got to be faster than everyone else. How do we use technology to help us to do that? So we've done, this part I call it integrating the machine into human. Okay, so about everything that we do in terms of fundamental analysis, predicting central bank policy, running the model, look at growth, all those are primarily done by Quant 2. I wouldn't call them machine, but they are, all the fancy model that we run them and we look at them systematically, flow of fund analysis, positioning, all those are done on a weekly and bi-weekly basis, and we see them in real time. Now, The late development we find in particular interesting are really using social media and Twitter and some of the Google search feed in order to help us to see if we can predict the coming political trend a little faster, a little bit more precise than the guy next door. So, for example, Brexit, when we had a very meaningful pound position for a few years, as a result that we had to follow very closely every politician saying something or every development between the European Council and the Parliament making a comment, we had to quickly analyze what does that feed mean. So we have used a lot of the AI tool to help us to get the analysis more faster and more accurate. And what we find is it has a little bit of lead time, sometimes 2 minutes, sometimes an hour, that just allow us to analyze the feed or the information a little quicker. So we have continue to spend resources on that. We have find some traction on it, and this is where we find the most interesting part of the second part of the investment about the information gathering that we can use technology to help us. The third part, I would say, to me, it is the most interesting problem to solve, and we have yet to solve it. And we have started about a year ago. We've been using, I would call the third part of the intertwine of the technology and the investment process is the investment itself, which is asset allocations. How do we put money in different asset class, in bond, equity, fixed income, and commodity? How do we efficiently asset allocate with the best risk reward when we try to solve the problem? So here we had a big debate because so far everything we have done is we integrate machine to human. We haven't done human into machine yet. So the debate here, do we integrate the machine to human again, or do we integrate the human into machine, or do we not integrate them at all? So we sit back and we said, okay, what is the two things that really stood out here? And I'm commenting this just on macro strategy alone because I don't know anything else, okay? So in the macro strategy, we find there are two things that machine can do and the human, each one of them had an advantage. One is that human has the ability to identify the environment and the regime more precisely, but they don't have the speed. The machine can scan vast amount of data, but they don't really have a lot of precision in terms of identifying regime. So, for example, I will see the Trump impeachment. I will automatically say, very quickly, I will know that two periods in last 100 years is most relevant that I need to go and look at how asset prices behave and make a judgment that what I think the future would look like, okay? I think machine is short of that. Machine is not going to be as precise in terms of zeroing in the regime. But what a machine can do, I cannot do is, the machine can analyze and quickly scan vast amount of data and come back with shorter period of pattern that I cannot do as well. The second thing, which is also, I think is really important in macro strategy, is that machine is very good at nonlinear processing, but the big money to be made in macro strategy is the nonlinear outcome, which machine cannot correctly capture the nonlinear outcome. So what we decided to do in last 6 months is to combine machine learning, AI, with our processes. We decided we're going to run them parallelly, not integrating them, not putting one into the other and see which one run faster, but we're going to run them parallelly, and we're going to call them the alpha machine. And we're going to try to experiment that to see if we can combine the strength of both, which is a much faster nonlinear processing, but allow us to capture the nonlinear outcome when the cycle turns, and hopefully that will give us a slight edge going forward.
Thank you, Irene. Technology is such a big topic, so please allow me to do a little bit advertisement. So we had the honor to invite some very well-known deep learning expert and who has written papers side by side with George Hinton, which is father of the modern AI, and he will be our afternoon keynote. I hope everybody stay tuned, and also including our panelists, if you're interested in hearing the deep learning expert, what he has to say. And lastly, when we talk about global investment, I really impressed with the knowledge of our panelists. But for a lot of our audience, there are many young students, and they are maybe 1 or 2 years at work. So I wondered, can you give them some advice that they can use right away? In other words, to invest their own human capital. So can you give very quick career advice to our young audience here? Thank you.
I think study history, learn to code.
And learning to code is actually, and knowing the history, especially since probably economics is more driven by history than by mathematical rules.
Maybe I'll divert the topic a little bit. I would say 3 things I always live by. First and foremost, do what you love. You know, like I've done this for 30 years and you know, it's still I feel like Christmas every day. I think it's really important to find something that you love and do what you love. Secondly, my number one rule when I pick a job, and among all the career that I've had, and I would say I have some really fantastic, I work in some really fantastic places. My rule number 1 has always been, I only pick the job that I'm going to learn the most. And every time I present, you know, opportunity to do a new job, I always say, okay, I'm only going to take the one that I'm going to learn the most. And consistently and ironically, it's always the one that who pay the least at the beginning. Okay, at my first job at Goldman, they want to pay me $26,000. I would try to explain to them, I can't leave like with $26,000 in New York City, and I try to negotiate to like $35,000. But that was half of what I would have got paid going somewhere else. But I was sure that that was a job that's going to allow me to learn the most. And you know, I would, and you know, it will all work out. The math all work out at the end. So that's rule number 1 I live by. The last rule that I always live by: if you have an opportunity to work, to find a mentor in, you know, investment, go and take that opportunity. And I did that once when I left the partnership with Goldman Sachs, and everybody thought I was out of my mind, leaving a very prestigious partnership, and I did. But to me, it was so obvious. I get an opportunity to learn global macro from one of the best investors in macro have ever lived. Why wouldn't I do that? So I think if you have the opportunity to have a mentor to teach you about the business, and that should be the number 1 job you should take.
Thank you so much. With this, we conclude this panel, and let's give this panelist a round of applause.